specialize in estate and succession planning. So this morning we're going to go through a very detailed plan with you. We're going to lay out all of the analysis that we considered when we went through our previous discussions with you and some of the financials we looked at for your business. And we'll go through that plan with you and exactly how you can implement it. So some of the main issues we saw pertaining to your current situation is the sale of your business, Miel Inc. So currently you, Susan, are considering retirement in the next 10 years and you're looking to sell the business. So you have a couple options with that, whether you'd like to sell it to your son Henry or to an outside party. So with that, we're going to consider some things such as capital reorganization of your current business structure and ways in which you can sell the shares of your business and obtain the capital gains exemption. We'll also go through some retirement planning with you and talk about your current investments and what you should consider investing in the future, as well as how you can maintain a stable income with the sale of your business. And we really looked at the valuation of your business. You collected a lot of very important clients over the past 10 years, and we see the value, the fair market value being $2 million, and we're going to go forward with that assumption. So our ultimate recommendation to you, you can see we'd like to reorganize the capital structure of your current business a little bit, and you, Susan, and your husband are going to hold preferred shares in the business, and your son Henry will buy in, and then later on we'll talk about some retirement and investment planning opportunities for you. Now just to take a look at your current situation, you mentioned to us you've been taking an annual salary of $225,000, so it's quite reasonable. Going forward, you'd like to have this kind of goal of retirement income per year, $100,000 to $125,000. And your husband is taking the same salary as you. He's got the 25% share. And we're also going to consider some of the additional costs that are going to be, you're going to have to incur, such as insurance. So we'll go into that a little bit, and exactly how you can get this capital gains exemption through reorganizing your capital structure. So taking a look at some of your personal finances, we recognize that you have some cash. Currently you're holding a couple of rental properties, which you're bringing in about $9,600 per year with that, so that's great. Your mortgage balance is about $100,000. We see you being able to pay off this very soon in the future. And tax-free savings account is not something you're currently utilizing, but it's definitely an opportunity for you. So further to that, we took a look at your RRSP balance, currently at $175,000. So considering your salary over the past few years of your working life, we assume that at each year you're going to have a contribution room of about $23,000. So in the past 20 years, you've accumulated a lot of contribution room, and we noticed that you haven't contributed a whole lot to your RRSP at this point. So this is definitely a great opportunity for you to use some of this unused RRSP room with the sale of your shares. So we'll go into that a little bit. And now taking a look at your son Henry and his situation. So he's a lawyer, he's gone through business school and had some great work experience. You definitely want to keep the business within the family. So he's willing to make some changes and adapt, move from Ontario to New Brunswick with his children and take over your business. So we really like this transition to go smoothly and also fairly. So we looked at a reasonable value for your business. And we see that Henry can achieve $150,000 annual salary, just based on the fact that if he purchases the business, yourself and your husband will no longer be as actively involved. So now just to outline kind of your current business structure, here you can see the main operating company, Miel Inc., and then you, Susan, you hold 75% through this holdco, which you have your rental property sitting in right now, and then your husband on the other side who owns 25% of the business. So we're going to go into a lot of detailed analysis on how we can reorganize the structure of this business and ways in which we can get your money out in the most tax efficient manner, and also benefit your son Henry in the best way possible as well. So Kellen is going to go and take you through some of this further analysis before we dive into exactly how to implement that.
Thank you, Sarah. So, when considering the business valuation, it's very important to consider that yourself and your husband are receiving cash flows of about $450,000 annually. So that's not insignificant. And a general benchmark that you can use to value a business is what people are willing to pay for it. And we know that you received a bid from one of your competitors for $1.9 million for this company. They've also attached some strict covenants to it to achieving certain revenue and net income benchmarks. And this is a little risky because we see this as perhaps a chance for them to try and get you to default on those covenants so that they'd be able to take over the company for a significantly reduced price. So that's a significant risk with going with the rival bid opportunity. However, since they've made a financial offer, we're going to use this as a benchmark for our fair market valuation. Now, when we are considering a fair market value for your son Henry to purchase a business, it's important to consider that he's not as financially secure as this company that's offered to buy your business. So there's a bit of a risk premium to take into account, and we think that a value of $2 million is reasonable for a fair market value considering the competitor offer and the risk premium associated with the situation. So in all our calculations moving forward, we're using $2 million as the fair market valuation for the business. So one of the options to have Henry take over the business is through a capital reorganization. This is to be a Section 86 reorganization. The big advantage is that it allows Henry to finance it over time. You would exchange your common shares for preferred shares of the organization. They would retain voting rights so that you keep control of the business if you want to get back in at some point. However, they would be non-participating. So the value is cut off, and all future value and all future growth of the company accumulates with Henry's shares. Now, one of the things this allows us to do is utilize the capital gains exemption. However, right now, since you hold the shares of this company in your holdco, and you also hold your rental properties in that holdco, you will not currently meet the 9% active business asset criteria. So as of this moment, you do not qualify for the capital gains exemption, which is why, as Paul's going to go into later, we're going to transfer those shares out of that holdco so you hold them personally and then qualify for that capital gains exemption. In addition to the shareholder loan option, or in addition to the reorganization of capital option, there's a shareholder loan option. Now, in most cases, if this shareholder loan is on the balance sheet for two consecutive years, then the amount of the loan must be included in the income of the receiver. But there's a specific exception for those who are using the shareholder loan in order to purchase equity in a business. So as long as you set up specific contract and payment terms, and Henry was paying interest regularly on this loan, then it would be legitimate and it would not have to be included in his income immediately as long as he followed the payment schedule. Now, this would allow you to pay out Susan her preferred shares immediately to get some cash at the time of sale, which is an option, or one of the benefits of this option. So, with all this considered, we broke down the three main alternatives that were valuable for worth consideration. First is the estate freeze that we already talked about using Section 86 to reorganize the shared capital of the organization. Now this would be put an internal freeze the value of the equity already gained, and make sure all future growth accumulates to Henry. The second is a shareholder loan to Henry. As long as the contract terms are followed, then this could be a viable option. However, it is a big risk. If the contract terms are not followed, then it could be a significant tax burden for Henry. And the third is to sell to the rival firm for the offered $1.9 million. So when we came to our decision, we really considered 5 key factors. Whether it gave you good retirement planning options, if it could help you utilize the capital gains exemption, which left you with control over the company if you wanted to get back in, if it had good succession planning options, and if Henry had the ability to finance under that option. And so with all that considered, we decided to go with the Section 86 reorganization of capital option. We're going to transfer your shares, or convert your shares into preferred shares, and Henry's going to get some common shares, buying at a nominal value, and then have the growth appreciate over time. And we're also going to work on some kind of revamping your investment strategy so far, so you're set up better for retirement in the future. And now we have a very detailed plan to make this work, and Paul is going to get into that right now.
Thank you, Cal. So when we're looking at the value of the current business being $2 million, that also includes some of the capital after tax dollars that you've already put into there. Now this is actually averaged among the shareholders, and you don't really just want to gift some of that out to your son immediately. So first thing we're going to recommend is you pay down the PUC, or the paid up capital. Those after tax dollars, you're going to pay that out. It's going to be averaged between your husband and yourself and your percentage ownerships. Then we're going to have Susan, you're going to transfer the shares to yourself personally and in a tax-free manner in order to avoid being offside holding those in your holding company, which has that investment property you're not using in the business. We're going to reorganize the capital using a Section 86, and Susan and your husband Richard, you'll both take in preferred shares equal to the fair market value of the company at that time, which will be a little lower because we just paid out that PUC, so it'll be $1.925 million. Finally, we're going to have Henry buy in over time. However, his initial buy-in is going to be financed by a shareholder loan for $300,000, which is again issued tax-free, not tax-free, issued as not an inclusion in his personal income, provided that those contractual obligations and him repaying on time, providing that that is met. So the paid up capital is $75,000. It would be capital dividend. And what we recommend you applying this towards is that mortgage payment. You're going to get all of this money out tax-free. And we notice in your investments, you are actually paying 3% interest on your mortgage. We feel that really your investments are exceeding that, so it makes sense to pay down your mortgage first and also to kick in a little cash and really just finish off that mortgage, because that's costing you more money than your investments are making you right now. Next, we're going to have Susan transfer the shares to herself personally using a tax-free rollover. We'll roll them over to a holding company and then wind up the holding company so that she's holding the shares personally. Now, this will throw her on side for the capital gains exemption. She won't be holding those non-active business assets, namely her two properties. Finally, we're going to use the Section 86. Again, get those preferred shares in the hands of Susan and Richard, and at the fair market value. Now, with Richard, he has his preferred shares, and they're underneath that $800,000 capital gains exemption limit. Great, you'll be able to receive that tax-free when his shares are redeemed. However, Susan, you are over this limit, and this could actually trigger some tax for you when you redeem your shares. So we're going to go through and maybe talk a little bit about how to reduce that tax burden you're going to be facing. So above the $800,000 limit, we have a capital gain of $643,000, half of which is taxable. Now, we also notice that you have a significant portion of RSP room. So when you contribute to an RSP, essentially it's deductible from your taxes. So it's almost as if you didn't earn that amount of income. So we're going to recommend that you put in $300,000 into your RSPs today, use up that room that you have, and minimize your taxable capital gain that you have. You're already planning for retirement, and we've identified that you need some more retirement assets. Get into it earlier and let it grow faster than you would otherwise. So when Henry buys in, it'll be at a nominal value to himself personally, but not an adjusted cost base. What's going to actually need to happen is Henry will need money in the company, and he will need money that he will have to distribute to Susan in order to make her RSP contribution. So what we're going to have him do is take out a shareholder loan for previously unissued common shares of the company. And then within the year, Susan will redeem $300,000 of her preferred shares and then contribute that towards the RSP in order to minimize her tax. So the new structure will be Susan holding the holding company with the property in it, Richard still holding his preferred shares, and me with Henry holding 100% of the common shares. So it's worth noting, though, that some of these preferred shares can be written up in a variety of ways. As I'm sure you know, if you're a lawyer, I'm sure you've seen the documents before. So some of the things you might want to consider is having more voting rights. In case Henry just I don't know, maybe he isn't running the company, you like it, or maybe you're not going to realize this investment, and that's scary because this is your retirement. You want to be able to retain control of the company, so you can come in, step in, take control of the company again, get it back on track, perhaps sell it off to someone else. We don't want to think too much of that, too much along those lines, just because it's a bad place to think, but we want you to be secure in your retirement. They can also be issued dividends at a regular rate, at a prescribed rate on the shares. Now, with your personal tax, again, we talked about the capital gain that you will be incurring, and the $300,000 RSP contribution. However, we feel your RSP right now, they're not very, it's very risk adverse. And the problem with the way you're investing right now is you still have a little bit of time before retirement. You still have some of those other assets like your properties. You will still have the preferred share of the business. So you're not wholly dependent on that. And we suggest you move it up to a slightly riskier investment portfolio that yields hopefully around 3% a year. Taking this and the $300,000 contribution into account, that would generate $30,400 per year just in RSPs. We usually will tell you that you have about another $5,000 of Canadian pension plan income. As well, you're still going to be having those preferred shares, which will either be redeemable over the entire time they're going to be paid out, or you will be receiving a dividend upon them. All of these taken into consideration, we can see your income being at about that $100,000 level that you really wanted to achieve in about 10 years. Also factoring in more RSP contributions as you go forward. So our implementation timeline, right now it's June, we're in the summer, we're not thinking too much. We're going to give you a little bit of time by August to have issued that capital dividend for the paid up capital, take that out of the equation, and to transfer those shares so that you're holding them personally. By year end, we hope to do the capital reorganization, so you're holding the preferred shares of the corporation. And in January 2015, we want Henry to buy in using that shareholder loan and make that distribution to Susan. So some of the risks here is that we can be deemed to be doing this for, be deemed to not be doing this transaction at fair market value. And really, what the CRA is concerned about here is that your son would put in a whole pile of money, and what would happen is that when you pull that money out, you can pull it out as that paid up capital, tax-free, because it's averaged across all shareholders. However, for transferring at fair market value, we've already paid out your paid up capital, and we've clearly defined what the terms on the shares are, so that you have no paid up capital, and the common shares have a lot. When it is pulled out of the company, you will not be deemed to have a dividend instead of a capital gain. Now, you do currently face a disability, and we are going to want you to supplement your current insurance, probably with a little bit more. However, it does hurt your ability to take control of the company should something go wrong. It's something that we had to consider, but either way, it seems like you might not be able to work if it gets bad enough in that situation, and you do need someone else at the helm. Richard might be okay, but he doesn't want to do this forever either, so that's what we came up. We saw this situation as mitigating the most risk. The preferred share rights are really your go-to mitigation option for control. You can take control of the company if things aren't going the way you would like them. Now we have a few other considerations. Jennifer as a bookkeeper could be great to split some income later. You can issue dividends to professional corporations. Children of them. You have 2 children, so it might be worth setting up a family trust later to get a larger capital gains exemption. Maybe a holding company could be beneficial in terms of having income distributed to the holding company, and if you don't need it immediately, you can use it. Home relocation loan and just kind of the backup plan. You have Richard to take care of the company if something goes wrong with yourself or your family, or perhaps your mother if she's still well enough. Now for Susan, you don't want to take more income than you need when you're in retirement, because your old age security will start to be clawed back. So if you can, live under that, but at the same time you have ample resources if you're not, if you need them. Now finally, our conclusion is the estate freeze and lock in the value and pass along to your son.
concludes the presentation. Do you have questions now?
I was wondering if you considered Henry's abilities to take over. I know he doesn't have any client contact, direct client contact right now, where he's working.